Why would someone go through the trouble of using a trust in the first place? A fair question most people start to ask as they become more established in their lives. Career growth and a growing family can really get you thinking. And when I say the question is fair, I mean it. Because trusts do not really matter until they change outcomes, especially tax outcomes. Welcome to part 3 of the Trust series. In this video, we will break down how trusts actually change your taxes by focusing on real-world applications, exploring what having a trust is really like. By now, you understand what trusts are and have some familiarity with how the different types work. If not, maybe scan the chapters in part 1 and 2. This time I want to focus on their value, revealing why they have the reputation of being the juggernaut of financial planning. The first idea you need to lock in is taxes follow ownership, not effort, not hard work, not how busy you are. Ownership. Let's start with business owners, because they have some of the best use cases. Imagine you own a business that generates strong income. Right now, the business is in your personal name or in an LLC that passes income straight to you. So every dollar the business makes shows up on your tax return. That means high personal income taxes. No flexibility in timing, and no separation between you and the business. But what if you did some restructuring? Now the trust owns the business, not you. You even made yourself an employee of the business, not the owner. What changed? The business still earns money. Clients still pay. Revenue still comes in. But now profits do not automatically flow to you. They flow to the trust. That matters because a trust has more ways to control taxable income than an individual does. As an employee, you get a salary. That salary is taxed like normal income, predictable, manageable, planned. But the business profits now live inside the trust where timing and distribution can be controlled. This is why business owners use trusts. Not to hide income, but to separate roles. Owner is one role. Employee is another. And when you separate them, taxes become a design choice instead of a surprise. Now let us talk more about how trusts are taxed, because this is where people usually get confused. A trust can be taxed in 3 basic ways. First, if the trust keeps the income, the trust pays the tax. Second, if the trust distributes the income, the person receiving it pays the tax. Third, in certain setups, the grantor pays the tax personally, even though the trust owns the assets. That third one sounds strange, but it is powerful. Because when you pay the tax instead of the trust, you are letting the trust grow without being reduced by taxes. In plain terms, you are paying the bill so the asset does not have to. This is one of the cleanest ways wealth moves quietly over time. With 3 ways to be taxed, the trust can effectively choose the income it wants to be taxed on each year. Simply put, a trust has options. The trust can retain income, distribute income, split income across beneficiaries, or time distributions strategically. Now here is the key advantage. An individual has one tax return. A trust can involve multiple tax outcomes. That flexibility is the entire game. As helpful as that was, not everyone is a business owner, so let us choose something more common. A house. Most people think putting a home into a trust is just about avoiding probate. That is true, but it is only the beginning. If you own your home personally, it is part of your estate, fully exposed to legal issues, and locked into your personal timeline. When a trust owns a home, control changes. For families, this means smooth transfer if something happens to you, clear instructions for use or sale, and protection for heirs. But for real estate investors, the value goes much deeper. Imagine the trust owns multiple properties. Rental income flows into the trust. Now the trust can distribute income to beneficiaries in lower tax brackets. Retain income for reinvestment. Separate rental income from your personal return. And protect properties from personal liabilities. If you own rentals personally, every dollar shows up on your return. If a trust owns rentals, income becomes manageable, not automatic. That is why real estate investors love trusts. They turn income into something you can direct, not just receive. Now let us talk about something most people do not realize. A trust can distribute income in ways an individual cannot. As an individual, income is income. As a trust, income can be split across multiple beneficiaries. allocated based on purpose, directed toward education, housing, or support, timed to years where taxes are lower. This is especially powerful for families with adult children. Instead of handing over a lump sum and hoping for the best, the trust becomes a filter. Money moves with rules. Rules reduce mistakes. Rules reduce taxes. And rules preserve structure. A misconception I want to touch on is this. People hear trust and think it is only for the ultra-wealthy. But the real dividing line is not money. It is complexity. If you have a business, rental property, children, a blended family, liability exposure, you already live in a world where structure matters. Trusts do not create complexity. They organize it. And when complexity is organized, taxes tend to drop as a side effect. Here's the takeaway I want you to leave with. Trusts do not save money by being clever. They save money by being intentional. They let you decide who owns assets, who receives income, when taxes show up, and how wealth moves forward. That is why business owners use them. That is why real estate investors use them. That is why families use them. Not because they are trying to beat the system, but because they finally understand it. If this video helped you see trust differently, not as legal paperwork, but as financial architecture, subscribe. And if you want the next part to break down common trust mistakes, or how trusts interact with retirement accounts and insurance, let me know in the comments. That is where most people get tripped up, and where the biggest gains usually are.